No, Stefan, down there for now. Yeah. Not yet. Okay, good afternoon, ladies and gentlemen. I'm Rajesh Merchandani, the Vice President for Communications and Policy Outreach here at the Center for Global Development. I'm delighted to welcome so many of you here this afternoon, braving the Washington, D.C. heat, although not as hot as it's going to be later in the week. Our event today is called Emergency Aid is Broken, Using Insurance to Make Disasters Dull. And I just want to start off by drawing your attention to this photo. It's on the screens around here as well. This is actually a photo that I took in a different incarnation a couple of years ago when I used to be a BBC correspondent. This was the aftermath of Typhoon Haiyan, then the most violent storm that had ever been recorded. And this was taken from a helicopter flying into the city of Tacloban, which was the worst hit area. And you can see the scale of the devastation that it wrought. That's a ship, a tanker that's been lifted up and just dumped in the middle of part of the city. And of course, that area is where the poorest people made their homes, as you can imagine. This is what it left behind in the city of Tacloban. But the truth is that millions of people live with the risk of disaster every day. Rapid onset disasters like cyclones, like this one that hit in the Philippines, or slow onset disasters like drought or the threat of conflict. And in the aftermath, governments and aid agencies set up appeals for money for the relief effort, and donations, in this case, donations were initially extremely generous, but as usual, they always drop off. People start off very generous and they respond, but then they do drop off. That's often how it goes. We wait for crises to happen to collect money from donors, and that delay in itself costs lives and dramatically raises the costs of responding. As a result, last year, there was an $8 billion gap between what frontline agencies requested to tackle crises and what they actually received. We can do better. Our panel, which includes the Chief Economist of DFID and senior specialists from the World Bank and USAID and CGD, they're today going to discuss why emergency aid may no longer be fit for purpose and how insurance can fix it. Unlike aid, insurance contracts pay out quickly under unambiguous conditions, and they can actually increase our spending on disaster risk reduction. Another example of that from the field, back in the days when I was a BBC reporter in the UK, in the summer of 2007, the UK experienced unprecedented floods across the Midlands region. I was out covering them. And at that point, insurance companies started to warn people in flood-prone areas that they would not get flood insurance in the future if they did not spend money on flood-proofing their homes, on some kind of precaution. So you see, the availability of insurance there made people invest more in disaster risk reduction. Just another example for you. Today we're going to hear about 3 work streams that our panelists are involved in this area. And let me just invite them all up onto the stage. Panelists, if you'd like to take your seats, I'll introduce you as you come along. Sitting right here is Stefan Durkon, who's a Professor of Economic Policy at Oxford University and the Chief Economist of the UK's Department for International Development. In the grey suit over here is Daniel Clark, the Senior Financial Sector Specialist, Disaster Risk Financing and Insurance Program at the World Bank. And together, Stefan and Daniel have co-authored a new book called Dull Disasters, How Planning Ahead Will Make a Difference, which actually comes out in the US today, I believe. Yeah. Quick plug, available to buy in the corner. We don't get a cut of that. Lena Heron is the Senior Rural Development Advisor at USAID. Her work considers how insurance can be part of longer-term resilience and development. And Theo Talbot, at the end there in the stripy socks, senior analyst at the Centre for Global Development, my colleague based in our office in London, who along with Owen Barder is leading CGD's new working group on catastrophe insurance for humanitarian and emergency assistance. The working group is looking at innovations that make insurance a workable solution against the effects of large-scale disaster, and how it can get round the fact that very few people in developing countries can take out insurance. We'll start with a question each to the panelists, then we'll have a moderated discussion, and then we'll open to questions from all of you as well. So panelists, thank you very much for joining us. Welcome to CGD this afternoon. Stefan Durkon, let me start with you. The Chief Economist at DFID. It spends billions of pounds, and therefore slightly more in dollars now, each year. You've written this book with Daniel about how the world could save much more money and make emergency aid more effective by using insurance. Explain a little bit about that. What do you mean by using insurance for aid, and how can donors start doing this?
Well, thank you very much. Well, as we just mentioned, we just wrote a book about this. It's available outside, I think. But the real thinking there behind the book was, for both Daniel and myself, been observing the typical sequence that Raj has also already mentioned. When big natural disasters, big events like earthquakes, like floods, like also slow onset disasters like droughts and so on take place, usually when a crisis like that happens, you'll get, at some point a disaster being declared, you get appeals, you get the request from people from their local governments from national governments to the international community, NGOs to the willing public, all to just appeal to actually donate money. But that's afterwards. That's afterwards. And one of the big consequences of doing this after the event is that you actually, you don't really know exactly what you will be spending it on. You haven't really thought carefully about how you're going to use it. And you get a lot of incentives that those who've raised it, to use it all for their own purposes, to be the clear benefactors themselves. You get lots of incentives to get, like, for example, after the earthquake in Nepal, to get 7,000 NGOs to be active in doing the relief after a disaster. Something like 30 countries or more giving support all to different programs. You have strong incentives to be uncoordinated, because we always say that we like coordination, but none of us like to be coordinated. We're getting all kinds of issues also in this whole process of fundraising, where people say, well, should Germany now pay? I'm a German minister, should I now pay? But let's wait what the UK is doing. Maybe someone else. You get strategic delays. You get those who are launching the appeals, who end up maybe crying wolf and saying, well, we better ask for an awful lot, because otherwise we don't get enough. Now, all these things create incentives, not to spend the money well, to spend the money uncoordinated, to make it all very politicized, to make it all fragmented, to make it uncoordinated in all kinds of ways, and to actually, as a result, not really getting the support to people what they need. So what we're proposing when we're saying we want to use insurance, actually, we don't want to necessarily start selling insurance. This is not about, oh, let's go out and sell insurance to poor households or sell insurance to governments. It could be part of it. But in the first instance, let's think as if we're trying to set up an insurance system. So where we actually set up a system that tries to think carefully about what are the risks we're actually going to cover. What should people themselves do? Should they buy house insurance? Should they have smoke alarms? Or should they actually, under what circumstances will they get aid? Can we get clear decision-making processes that are clear about under what circumstances people get support? Can we also get a very clarity? What is it actually that the support will be? What will we do? Will we target certain types of people and so on, and make it all clear beforehand? And once we have clear plans and clear triggers, clear process of decision-making, let's actually think very carefully about what will that cost us beforehand. And think through very carefully as if you're going to arrange standby financing. And you get the financial planners in that think through it. Maybe we can buy insurance products for some of these things. Maybe we'll set up some risk pools. We get some contingency funds. We'll do some other things. But basically, have a clarity in terms of what is being supported, who bears the risk, and what is the risk exactly that will be protected. Have clear decision-making process. Have clarity about who will be acting on when the crisis happens, and then also have the very clear financing arranged beforehand, so that you don't have to do as it is now, which is going and beg with begging bowls, as if we haven't passed the 12th century, as if financial instruments are basically as if we haven't really gone beyond medieval times. We're just going to, whenever there's a crisis, we're going to beg, and then we'll see what we'll do with the money. No. Let's arrange these things beforehand, be clear, and have the logic of insurance guiding us, and maybe once in a while buy an insurance product along the way to actually help us to make sure that this financing works.
Okay, Stefan, let's just pick that up with Daniel Clark, your co-author. Daniel, we've heard from Stefan about how insurance, could work in emergency situations, and it would take us out of what you guys call this medieval mindset that we currently have at the moment with benefactors and begging bowls. In your book, you talk about how some governments are using insurance to finance disaster response. Explain to me what their motivation would be. Do you think that why they're doing this, and what evidence there is that it actually works?
Okay, so firstly, nobody wakes up in the morning and thinks, I must buy disaster insurance. And the government's no different. So we've been working on this topic for, I guess, the last 10, 15 years at the World Bank. And if you look at countries that now do this pretty well and they're financially protected against disasters, they start off by asking 3 questions. Firstly, who do I want to protect? Secondly, what do I want to protect them against? And thirdly, who is going to pay for the protection? So these are policy questions. Once you've figured out who you want to be protected or what, so you want, for example, schools to be rebuilt very quickly after a disaster, or you want to make sure that households aren't plunged into food insecurity because of consequences of a drought. So you've worked out who you want to protect, against what, and who's paid. Then you can start thinking about the solutions. And as Stefan said, the solution isn't necessarily insurance, but insurance is the inspiration. And what you need is 3 things. You need a plan for what's going to happen. You need a decision process for who's going to make what decisions when. And thirdly, you need the financing. In terms of what the evidence base for whether this works, so we've just been working over the last couple of years with Berkeley, University of Berkeley, and Government of Mexico to do the first ever rigorous impact evaluation of a sovereign program to finance disaster response. This is in Mexico. Fonden, this is their fund for natural disasters for reconstructing public infrastructure. And what we found in this impact evaluation is that just by changing the financing, changing the way the financing flows after disasters and planning better beforehand, leads to a 2 to 4% increase in post-disaster GDP. So this is a big increase, and this is just because of the change in the way that the financing system has worked towards something more like insurance.
Interesting. That's a 2 to 4% increase on pre-disaster levels.
Post-disaster. So after a disaster, with the financing system, the GDP is between 2 and 4% higher after the disaster than it would have been with the original system of financing.
Right, that's what I meant. Yeah. Very interesting. Lena Heron, Stefan and Daniel have talked about insurance contracts, insurance thinking for emergencies, and from better planning. Your expertise is focused on long-term development and the long-term development payoffs, the development dividend, if you like. Why do you think insurance could play an important part there in terms of its role in longer-term resilience and development?
Right. Well, we've been working for a number of years on these issues, and Stefan and I were talking earlier that in fact we don't think this is insurance is never going to be it's not a silver bullet. It's not really meant to be a standalone solution, but that it could be a really powerful instrument to use to support development and resilience agendas. We have found, and we're beginning to accumulate the evidence that if you pull some of the risk out of the system, that you can really get the kind of development changes that can really support longer-term resilience as well. So for instance, get people to adopt better practices or more resilient varieties using improved seeds or other kinds of technologies. These are the kinds of development impacts that we're looking for. But they also will reduce some of the risk exposure as well. And I think a really important point, and where these kind of discussions come together, is where you start to get these kind of approaches working at different layers. USAID a number of years ago, 2012, I think it passed a policy on resilience, and where we're really starting to shift away from looking at disaster, at these events as kind of anomalies, right? That we're looking at them more as, especially looking at recurrent crisis. And so we really want to build up the capacity for states, regions, communities, individuals to better manage risk and respond and adapt to crisis. And I think if you start to look at the way the kinds of instruments that Stefan and Stephen are talking about, Stefan and Daniel are talking about, and the way it can be layered with the kinds of instruments that we've been using on the development side, that you really start to look at a risk layering approach, that when you start to reduce the risk on one layer, it reduces the contingent liability of risk at other levels.
Thank you, Lena. Theo, we've heard from all three panelists. Lena just recently told us about the important role insurance can play in the humanitarian development kind of divide, that continuum. Tell us a little bit about the work program that you're developing here at CGD on this, on insurance for emergencies and disasters. You know, why is the way that we respond to disasters now wrong? Why do you think insurance contracts can fix these problems? I think you've got a couple of slides that you're going to show us.
I do. Well. I'd also love to be able to click through them.
Where's the clicker? Let me find you where that clicker
is. That would be great.
Start slowly.
I'll start really slowly. Thank you, Stefan, and Daniel, and Lena. I'm killing time, Rajesh. But no, really thank you. It's an honor to be here. As ever at CGD, we benefit greatly from our friends and networks, and our friends and networks, in this case, in this space, are exemplary. Stefan is co-chairing, along with my colleague, thank you so much, along with my colleague Owen Barter, the working group, which I'm about to tell you about. But before we jump into this kind of cut and thrust of our discussion about why we think disasters are insurable, why we think a large share of the humanitarian caseload should be financed fundamentally differently, I want us to convince ourselves, as I had to convince myself, that there is, in fact, a problem to be solved. So we're going to start out by looking kind of at the end of the problem. And this is a figure which Stefan, in typical Frank fashion, I hope you'll forgive me if I violate the Chatham House rule of our working group, referred to as specious, except he used a much ruder word during the working group. And this is the amount we spend as donors, the global public sector, on disaster risk and resilience. So preparing for future disasters is this green segment. And it's a vanishingly small amount of the history of aid spending. If you look at the DAX creditor reporting system, we've spent about 40 cents out of 100 real dollars. And Stefan is right. There's lots of things that should be called resilient. If the Global Partnership for Education builds stronger schools, we should call those contributions to resilience because they'll be more proof against earthquakes. So there's an addition problem here. But even if this is wrong by a factor of, let's say, 10, that gets us to $4. I don't think it's wrong by a factor of 10. That gets us to $4 out of every $100 of aid in the last 2 decades going to protecting ourselves against disasters. Now, compared to the kinds of returns on investment from disaster protection that Daniel's team at the World Bank has been pointing to, that Lena has with formal and kind of anecdotal and informal evidence through experience generated, and that Stefan has seen throughout his career, that's a woefully inadequate amount of investment relative to the opportunity. So I'm going to make 4 points today to try to convince you to do things a little bit differently, convince all of us. One is too little, and that's the point that we see on the screen. We spend too little on preparedness. The second is too late. We don't respond effectively. This is a failure of financing as it is designed. And the third is too bad, that our failure of financing and our underinvestment in preparedness disproportionately affected the poorest people, the people without a voice at the table and without a seat at the room. So what do we mean when we say that our response has been too little? This is a specific example of what I think is a bigger problem. When we add up how much frontline agencies are asking for in the so-called humanitarian response plans or strategic response plans, we see this growing deficit. Why is this deficit growing? Probably a couple of things. We haven't spent enough on preparedness. We also have a lot of things that are labeled as humanitarian aid that really should be in the development aid bucket, right? We probably have a lot of problems that should cross the humanitarian to development divide. But we also have things that are unique to the way we do this, which is that we wait until something has gone wrong to fund it, and that creates these perverse incentives. We often delay the amount of funding that is received, and we lose lives and run up costs as a consequence. And when we do provide funding, it's in this straitjacket of annual disbursement cycles, donor coordination, these heavy-handed cost administrative procedures, and that, again, takes money, lives, and time. And this creates 2 distortions that I think are really important, and this is where I think that we might have some interesting contradictions and discussion in the room. The first distortion is that these numbers are probably lies, because we don't know how much disasters actually cost. On average, humanitarian response plans are 50% funded. And if you knew that every time you asked for $1, you got 50 cents back, you'd probably start asking for $2. So we don't know what the size of this deficit is. But more perniciously, I think it undermines incentives to do better. it might sound really uncharitable to say that frontline governments in vulnerable countries need incentives to spend money on protecting their populations. But for those of us who've worked in line ministries overseas, we know it's the truth, right? There's opportunity cost to spending today. You can save a life on average for £4,000 per bed net. When someone says that and says, no, we should build our seawalls for after your term has ended, maybe a typhoon will come, that's a much harder commitment to make. And Daniel, Lena, and Stefan have smart things to say about that. So we have this mismatched, underserved, distortionary way of financing. That's the failure that we're facing. I also, before I get to how we fix it, because it's not all doom and gloom, how we're proposing to fix it needs to happen because the burden of the way we do things falls tragically and fundamentally on the poorest people in the room. The poorest people in our global society are the most affected. The leftmost bar is the share, in orange, is the share of damage. So if you look at stuff, the share of damage in countries. And the lowest countries, a highway in Tokyo is worth more than a highway in Sri Lanka. So sure, that makes sense. If we look at the loss of lifetime income, again, that kind of makes sense. My colleague Michael Clemens talks a lot about the differences in per capita incomes between countries. And it's not surprising that, again, in terms of lost lifelong income, poor countries lose less. But if we think about lives as equal across the world, poor countries are overwhelmingly the losers from the way we do things. The burden of death falls disproportionately on the poorest and least able to cope places. So finally, what can we do to fix it? Stefan and Daniel have talked about insurance thinking, and Lena has hinted about the importance of crossing this insurance divide. We started out by saying that we have insufficient money. Probably we have insufficient money relative to needs. One way to answer that is using insurance. We think of insurance as cars and homes, but the global insurance industry, as Stefan and Daniel and I have learned in the context of this working group, is extraordinarily deep, capital deep, and extraordinarily sophisticated. The payouts in insurance are whole integer multiples of the payouts that we make from the aid budget. The second point we made is that it's mismatched because stuff shows up in the straitjacket of annual funding cycles, after the fact, donors chipping in, what Stefan and Daniel in their really fantastic book, 1799, I believe, available in the lobby, call benefactors and begging bowls. And that's not the way insurance works. Insurance pays out on time and in full, or it's a breach of contract. And we know this from our own lives, from introspection. And finally, we think about distortions. There's this old truism in kind of information economics that nobody washes a rented car, and that's true. But we would spend a lot more on disaster preparedness and resilience if we acknowledge the liability that we would have to do if we insured ourselves against it. Not unlike you or I get lower premia for driving more safely or installing better fire alarms in our houses, the same kinds of incentives can be brought to bear on international development problems and particularly humanitarian development problems. So that's my pitch. I'm sticking to it. I hope you have questions. We've put a lot of this thinking, this very broad thinking, setting out what we diagnose to be the problems in our framing paper. Our colleague Mary Ellen kindly provided copies outside. But we also have a working group that I particularly want to tell you about with my 15 minutes on the soapbox. And this working group is chaired by Daniel and my colleague Owen Barder. It's run out of CGD's London office and supported by UBS, the Swiss financial provider. What we're doing is bringing together humanitarians with donors, with representatives of southern governments like His Excellency Atou Soufiane, I think one of the longest serving finance ministers in sub-Saharan Africa, and an old friend and colleague of Stefan's. And we're asking them, what can we do to scale up solutions that we know exist and work, like sovereign risk pools in the Caribbean that Daniel's team has worked on, in the Pacific, and African risk capacity, which is run by our own, or the secretariat of which is headed by CGD's own Dr. Ngozi. We know that the solutions work, so how can we scale them up and across? How can we create a deeper market of these insurance-type contracts that pay out in full and on time? Because when we think that we can, we'll save lives, we'll save money, and we'll save time. And it's our kind of ardent hope that by doing all this, we can achieve much more of what Stefan and Daniel have challenged us to do, which is to make these disasters, which are right now tragic, to make them dull.
Great. Thanks very much, Theo. Thanks, panelists. We'll open up for questions from the audience in just a minute, but let me just explore a couple of those points with you. Stefan and Daniel, this idea of the costs of not doing anything are enormous when a disaster strikes, but you've also been looking at the costs in long-term effects of disasters, the long shadow that these events can actually cast. Can you talk to us a little bit about what you found in that?
Well, I'll start, and Daniel should complement. Of course, there's been quite a lot of research on the kind of long-term damage that things like droughts have done and big weather-related events. One of the things when it happens in poor countries, it's not just that at that temporary moment people are maybe exposed and they lose some income and so on. Nutrition and food security get fundamentally affected. You lose human capital. You lose people, but also because of undernutrition for young children, we have losses beyond it. And so when you start quantify it, it's across a range of countries, these uninsured, these non-protected big events, it could be something like 4 to 16% lifetime earnings losses simply through one event that people exposed. Now, of course, we're not even counting all the people, as Theo is referring to, people die and also, of course, are lost in that sort of way. So we do have these permanent consequences. I think it's in any kind of cost-benefit analysis. If our response is late, for example, there's been interesting work, on Ebola, on the pandemic, on that was happening in Sierra Leone, Liberia, and Guinea. Just being a month earlier would have probably saved about half the lives that were in the end lost. So there was a Lancet paper, something like 8,000 lives would have been saved if the response had been 1 month earlier. Now, that's a clear example where something goes fundamentally wrong, because the response started really by the end of July when an international emergency was declared by WHO. But actually, we knew by February that there were Ebola cases. A month earlier with something that is really properly incentivized decision-making would have actually not been that hard to achieve. But here we got decision-making being very poor, we got delays in decision-making, procrastination at the WHO, that actually meant the decision wasn't just not taken, that actually it was important enough to intervene. And so these are the kind of things that we have long-term losses for not acting earlier. And I just wanted to add something in terms of, why do we think it will save money? It's not just because we'll save lives and reduce damage and we'll get the economy to start working again, but it's also just the nature of the response. If our car breaks down, we don't have breakdown insurance, it's extremely expensive to then get a replacement vehicle and then quickly arrange all the kinds of things. Think of often the humanitarian response system, is that something happens, then we'll start trying to get the overdrafts and the money together. All these things are very expensive. We need to maybe reallocate budgets from one thing to the other, so there's a big opportunity cost. So just everything doing after the event is just a very expensive way of trying to save lives and protecting people. Doing this beforehand, it may seem, oh, it's strange, we go to insurance markets or we're going to have savings pots or risk pools or whatever. And you start thinking, well, no, that must be more expensive. No, it isn't, because you don't really get this crunch moment when you suddenly have to raise the resources, suddenly have to hire all the people, getting all the vehicles there and everything together. If you plan this beforehand, it will all be much cheaper. And indeed, we would be able to save quite a lot of money. And these are so clearly things we can plan. We don't know when a disaster will happen, but we do know that it will happen. And it will be happening somewhere. These are the kind of things we can plan for and save as a result quite a lot of resources.
Daniel?
Yeah, so what Stefan's talked about is there are big economic benefits from acting early and acting more reliably. So if one of the stories that came out of the Mexico analysis is if businesses and families know that the schools, know that the hospitals, know that the roads are going to be rebuilt within a year of a disaster rather than within 2 years, this is one of the reasons why the economy grows more quickly afterwards. But even if you want to respond quicker and more decisively, more reliably, the way you finance the response can also be much more cost effective. So if you wait until after a disaster to start trying to mobilize resources, say for example by cutting the health or education budgets or the capital investment budget on an emergency basis, this can be quite costly for an economy, because often you take money from areas where it's politically easier to take money from rather than areas which are where developmentally have the lowest cost. Whereas if you start your financial planning before the disaster, you have a lot more options available to you. So we've been working for the last few years on a methodology which tries to put together all these different aspects into one melting pot, so you can really compare different financing strategies, and we've applied it to a few countries. And it's come up with results which are quite intuitive for people who've been working in this area, in terms of the value of having contingency funds or lines of credit so you can draw down the money quickly in the event of a disaster, but also particularly for the more extreme, unlikely events, having things like insurance. So insurance has a cost, but so does holding a contingency fund, and so does having a line of credit. And once you start accounting for all these the actual economic costs of these instruments, you tend to find that the most cost-effective approach is one, as Lena said, it uses a combination of instruments, each in their proper place.
Right, right. I just wanted to add to that, because I think we're talking about the cost of response and the cost of, comparing averting losses by responding more quickly. I think there's a huge dividend to be gained by having these risk management instruments in place, because as soon as people know that the response is going to be more quick, or they're going to be taken care of, or there's going to be some mechanism to get things started again, that it starts to give people the confidence to actually leave the house. I mean, if you take your analogy and apply it to a developing country context, the fact of the matter is a lot of people just stay home, don't they?
Yes.
Right? They leave potential economic gains on the table because it's too risky to take, to engage in that economic opportunity that may be all around them, right? So that risk management that they're doing through these autarkic kind of instruments, right, by investing in more cattle than, I'm just applying these same ideas to the household level. Again, because we need to think about how the household manages risk, the community, the sovereign, right? I mean, and they all fit together. Yeah.
So just on that point, panel, I want to ask this question to you. So, it's bad enough that I think one of you said, I think Daniel, it was like, no one likes to go and buy insurance. I mean, I'm paying money out and, I may never see anything in return. I can go and spend that money on anything I want today. For people in poor countries, they don't have the choice to go and buy insurance often because they don't have the money. But what about then governments in developing countries and even donor governments as well? I mean, they've got to make difficult choices about how to allocate funds as well. How do you incentivize them to make them think, actually, you know what, disaster insurance is a good idea rather than do something else? I'm throwing that open to all of you.
Could I jump in on this? Because this is something I spend a lot of time thinking about in the context of the working group, but also because I think it's kind of symptomatic of where our thinking is on international development more generally, which is that, as we were saying before, you typically don't insure things for which you don't feel like you have some responsibility or liability. And I think the really kind of pernicious secret at the heart of the way we currently finance things is that donors all have the flexibility to walk away. We don't need to put money into a pot after things go wrong. And that's something that you can't do if you're paying the insurance contract. Insurance forces you to acknowledge the liability. We'll talk a little bit about how this actually works, I think, maybe later, about so-called parametric insurance contracts. But the fundamental recognition that we're asking people to take, this final little baby step, is that we're on the hook. We're paying billions of dollars a year. And so pretend that we're not is kind of delusional, and it results in a sort of financing architecture, which, as we saw, is ultimately ineffective.
So final little baby step. So I would say, actually, this can be quite complicated. So when we have a government coming and saying, okay, the last disaster we had, the response didn't work so well, let's think about how to make a response better in the next disaster. And let's think about the financial planning, because this is fundamentally what, on the financial planning side. One of the first exercises we typically do is go through and look, maybe over the last 10 years or 20 years, who paid for what? So when disasters happen, who paid for what? And this could be local government, it could be people themselves, it could be national government, it could be international development partners. And we go through that exercise, and that's an exercise that helps people in all these different parts of the ecosystem to think through, well, what might their contingent liability be? To start thinking about, well, okay, I am actually going to pay. I can pay now or I can pay later. Ultimately, I'm going to pay. Let's try to pay in a cost-effective way. But this is very difficult. You have to think in a very risk-informed way, and the process is quite challenging. So I'm not trying to belittle the potential impacts of doing this well, but I think it is a very challenging process to go through.
Len and Stefan, how do you navigate the politics of this? I mean, how does DFID go to the voters of the UK? I mean, DFID comes in for a lot of criticism in the UK, potentially more so now. How does how does Priti Patel then go to the country and say, we're spending your taxpayer pounds on insurance rather than stuff?
Well,
I'm going to ask the same question to Lena as well, USAID, not just putting you on the spot there.
no, I'm because I think, well, I'm going to answer a slightly different question first and adjust it. And it's not trying to be the political and trying to get away with any difficult political circumstances we may find ourselves in the UK. No, I think the first thing to do is actually to ask yourself, why would anyone really pay for preparation? And it's still the fundamental problem we have when we were writing the book and trying to think very carefully about it. The fundamental problem is that all the evidence, whether it's from the US, from Mexico, from India, very careful studies that actually show, in essence, that there is a lot of political gain to be had to be the benefactor after a crisis, and there is no political gain to be had from investing in risk reduction and preparedness. We have that in the US, and we can get the details in the book, are the studies there. We know it from India, we know it from Mexico. These are kind of patterns. And it's this thing that I alluded to earlier, is that being a benefactor, being able to show I'm the one that comes to the rescue in the context of some kind of seemingly natural event that I couldn't have foreseen, that I couldn't have done anything about, it actually wins your votes. And that's the kind of the thing. So it's the first thing is there, that actually it's not just a problem from the UK to actually start saying, let's think like insurance or maybe even buy insurance, but organize the system. No, it is in general the case. So we need to overcome this. So in countries where some change has happened, it has usually been on the back of very bad events. A poorly handled response to earthquakes in Mexico City and in other parts of Mexico actually is probably behind why Fonden became something. Much better flood responses in Orissa is these days because at some point the government lost power based on the floods in Orissa in India. We're getting similar things in Ethiopia, that the productive safety net policy that had happened, the productive safety net program that actually for the first time set up some kind of resilience program, cash transfers, food for work type of programs, as well in Ethiopia for the poorest people, that came after the drought of 2002-03. Similarly now, conversations we have with the Ethiopian government, they felt embarrassed by the UN launching an appeal on their behalf when they're just trying to get foreign direct investment and textiles into the country. They want to show that progress. They don't want it. They want to sort out their financing. So it is arguably on the back of some of these things that the best incentives are there. For the UK, well, no, actually it is not that hard. For the UK, we have actually, if anything, we have in the city a very flourishing insurance industry. So arguably there's not a big question to be asked. If the UK wants to do it from its own national interest, it could do it. But I don't want to make that point. So I don't have a problem selling it to my ministers. But it is important that to actually show to the world that actually using insurance and insurance-like instruments is actually beneficial for you, and we'll need to grab any opportunity to actually do this. It is a fair question to ask, will you help us getting access to the insurance contracts? Will you help us buying the insurance? Will you even pay for insurance for these countries? And that's a fair question. And it's a hard one in the development world because you actually ask donors to pay for lives that potentially could have lost and not lives saved. So it's a very hard one to actually sell. But look, it is a commitment, it's a political commitment we need to make also to actually saying, look, we want to actually avoid spending these billions and billions that Theo is referring to in the humanitarian system that arguably is running out of money to actually for problems for which the financing model could just be very well be organized in a very different way. I can't say very easily how I'm going to use these principles in the context, say, of internal displaced person in Sudan or in South Sudan, or in this kind of fragility and conflict-related problems, although you think about it. But I do know in the case of natural disasters, I can actually offer something. And I can offer even to my ministers in London to actually say the prospects that we'll end up paying less per year on average on these kind of disasters than we do at the moment. Philippines, the Typhoon Haiyan, that's perfectly insurable event We used grant money from the UK to actually support the Philippines in Exposed. We could have just as well used grant money to work together with the Philippines to get insurance and insurance-like instruments to get these systems running. I don't see it politically as hard like that on the donor side. But I'm an optimist.
Lena.
Yeah, so trying to address that part of it in particular. So I remember when the African risk capacity was first kind of in development. And the folks putting ARC together came to USAID, kind of, if you think of USAID as one thing, and tried to get USAID as one thing interested. And they didn't get a good response, right? The problem is USAID isn't one thing, right? Again, you introduced me. I work on the Bureau for the Bureau of Food Security. That's on the economic growth side of the agency, right? There's another side of the agency that works more on humanitarian assistance. And we're trying to, through our resilience framework, and our Center for Resilience is now has a mandate to try to mobilize and better coordinate across these parts. But they really, we really are still these major parts of the agency that have different mandates, different pots of money, different mandates, really. And if you think that something like ARC or the kinds of responses that the book is addressing, right, that Stefan's talking about, that if you try to approach the folks that are tasked with responding to humanitarian need and disaster recovery, that they are so focused on that job that to try to get them to shift to developing the instruments and making that change happen, it's a very hard sell, right? Mm-hmm. And that's what I think some of the book addresses, but you really have to look internal to these donor organizations. The donor organizations are not one thing, and so really getting the parts of the agency, I think, it's more appropriately on the development side, looking to build the capacity within some of these host governments or build up some of the instruments that will more appropriately address this need. I think it's partly where we look to make this change happen within the donors. And then the second point I would make on this is that we have a lot of work to do, I think, to really be able to use these kinds of instruments effectively. They're very complex instruments, and maybe we can talk a little bit more about some of the pitfalls. I mean, I'm a promoter of these kinds of instruments. I support a lot of work to try to better understand how to use them, where to use them effectively. But as any of us who have engaged in this work know, there's a lot of potential downsides to these kinds of instruments. And one of the problems with the kinds of humanitarian crises that we face is they come from they're complex emergencies, they're complex crises and stressors. And it may be a drought that is the triggering event, but is actually much more complex. And that, in fact, a drought may be the kind of event that reveals a humanitarian crisis, but if it were up to some kind of insurance instrument or insurance kind of trigger, the drought may not be serious enough to actually trigger a payout of these with this kind of instrument, right? And I think that's something we need to work a lot more on is making sure that these kinds of instruments really address the kind of need that the folks who are working on the humanitarian aid side are working every day to address.
So I wanted to briefly come in and actually, because I think there's kind of 4 things that the international community could do, and I could think a bit more carefully about it. So, and it's all about in the idea, let's set up a system that is insurance-like and maybe uses insurance to some extent. Right. But so the first thing is definitely, we'll have to start from the settings where the risk is, the countries, and helping governments to get a real good understanding, together with their civil society, together with their firms, with their households, kind of a good sense where are the risks and what are actually, to getting actually that preparedness planning, these plans together with a clear recognition, these are the kind of risks, these are the kind of things that we need to protect. There's no way we can go to anywhere unless we do more work supporting governments to have actually a clear sense what are the risks they face. So secondly, there is, crucially, we'll have to think very carefully about, do we have all the appropriate instruments there? There are theories talking about this well, and we have them. I think they start developing, but making sure that for the kind of risks that definitely need somehow protection, do we have the appropriate instruments? There could be insurance, could be other things. But then there's two more things that are crucial here. I'm picking up on where Lena is talking about. So the third thing is, let's make sure that we don't end up in a situation where we end up as donors or as insurance companies mis-selling to these countries. So that we're actually helping, because these are not easy things. We'll need to have somehow support, some kind of, help with financial planning, help us honest brokers, that actually the right instruments are being put in place. Now, and finally, to have Lena's point as well, is to say, look, they are not perfect, these things. But it gives a right place where the current humanitarian system really should fit in better. Which is actually saying, look, let's do as much as we can the first three things. But clearly, we'll need to have a humanitarian system that can step in when these systems are failing. That can actually then say, look, now we need to actually provide. We can be the insurer of the last resort. We can take those things that we couldn't plan for that we actually properly protect. Now, that will still be quite a lot. But it's very different from a system that we have now, where the international humanitarian system thinks it needs to be there for every type of risk, for any kind of problem, and use all the grant because we're going to do need to loan. But actually for all kinds of things that just with better planning and preparation, they shouldn't have on their books. So they can focus on all these more difficult problems, and they can actually then deal with, as the insurer of the last resort, dealing the very complex disasters, the fragility link, the more conflict areas, and actually focus on. And that's the thing we could do.
So it could be sort of one tool in an armory.
Exactly.
It reminds me of actually, Thea, you worked on last year with the humanitarian cash transfers report, which was an idea we worked on with ODI about, after a disaster, what if you gave people cash to buy things from local markets and they could decide what they needed? Local markets would get they would get kick-started in the aftermath of disaster. You worked on that. Another tool, like insurance, that you could put in the armory to tackle disaster. But I just want to go back to, Lena, you mentioned the African risk capacity. A CGD Distinguished Visiting Fellow, Ngozi Okonjo-Iweala, was asking me why we're not talking about this in this panel, and we said, well, we are, and we will be. And so, Daniel, I want to just bring you in here on this. African risk capacity, the Pacific risk pool called PCRAFI, I believe. These are systems that exist, insurance systems that exist already. And I wonder if you can give us a kind of a critique of how they are doing, and in response to Lena's point, what are the downsides, what are the pitfalls that we have learned about systems like this that we need to address in the future?
Okay, good question.
No pressure.
So I think if you speak to anyone who has developed a sort of insurance-like solutions, this could be a reinsurance company, it could be a sovereign risk pool like in the Caribbean, Pacific, and Africa, they will say, we've got this fantastic product, but people need to buy it more and then they'll be better protected. If you speak to ministries of finance, particularly in developing countries, they will say, I've got a stack of prospectuses. I've got a long list. I've got all these proposals from insurance companies and these insurance pools on insurance products that I could buy, but I don't know how to choose between them. I don't know what the right choice is for my country, and I think so. So it's really an issue of lack of informed demand rather than necessarily lack of supply. So these pools have been incredibly useful for promoting better ways of financing disaster risk. They've also been fantastic for sharing risk information. So in the Caribbean, for example, a recent evaluation, one of the main impacts they found was just a better acknowledgement within countries of the disaster risk they faced, because every year the government, the Ministry of Finance, had to pay a premium. And as soon as you start seeing that appearing on your balance sheet, you really start thinking about the real cost of disaster risk. So I think there's a real, as Stefan's mentioned, there's a real role for having a sort of honest broker, so that ministries of finance are able, in a sort of safe space, to sort of ask questions about, how do I get better financially protected? It may be that the solution isn't just insurance. The solution may be a combination of instruments for different things, including a sort of backup systems as well for when insurance and rules-based approaches fail. So I think from the World Bank side, we really approach this in a holistic way. We think about this financial protection as being linked to disaster risk management, is linked to public financial management, is linked to climate change, is linked to agricultural development, is linked to financial sector development. It really is a policy area that's linked into all these areas. And where we see solutions working well, it's when insurance is fitting into that ecosystem, where there's a holistic solution to a problem and insurance is part of the solution. So in Mexico, as an example, we've talked a bit about this program, Fonden. Fonden has a very large reinsurance purchase every year and also a cat bond purchase. But that isn't the reason for the impact. The reason for the impact seems to be the system. And then this is part of the system that really binds it together, that glues it together, that makes it credible, that makes it function. So it's not that insurance is the solution. The insurance is a critical part of the system.
So we keep on wanting to repeat is this kind of this point, you don't start with a product. Don't start with the insurance product. Start with actually understanding your proper needs, have the information, and then insurance could be one of the products that you use within your financial planning armory. But it's the process around it and the whole system that it generates is just as important than just getting the right product somewhere.
Actually, there's a huge risk in governments going out and engaging in some of these, insurance products, buying into these systems or whatever, that they will then assume they're kind of covered. If they don't understand their liability, if they don't have a good sense of what the various instruments are, what their risk exposure is, and then put together this more holistic plan, that it's very easy to kind of get caught into thinking that just because you've bought one policy for something that you're kind of covered, you're good.
But to try to partially disagree with you, just to get a little bit of discussion here, is that, of course, if you think of it, if you just wait until after disaster, and then you only start doing your financing, then, of course, you'd absolutely have no incentive to understand anything. So at least in the whole process, just thinking carefully about the product and the whole holistic process, it at least makes things explicit. And maybe we still must make sure that they don't feel they're totally protected by it. But somehow we worry about. I mean, there have been, and I've been in conversations where senior officials of certain types of organizations tell to governments and say, no, look, you don't need to do here much, because if that happens to you, we can launch an appeal. And then you will get the money. And to get this false sense of certainty, of security of it. And I must say, this is a little bit, for example, what was told to Ethiopia, saying, no, you don't need to keep big funds ready to actually, in case there's a drought, because it could have happened any year, because then you go to the international community. In fact, the Ethiopian officials tell me that's what they thought, that's what they understood the global commitment was. And of course, then they were very much cheated, because in the end, they had to find $880 million from their own books. Thank God oil prices were low, because they could rate the oil fund, the stabilization fund that they had sensibly set up, to actually pay for the drought response, because actually they needed 1.4 billion, but donors only gave, exactly the kind of percentage we usually get, something like just under half.
Sorry, Rajesh, could I come very quick? So I think I agree probably on the balance of things with Stefan's analysis, that we shouldn't, in thinking about this, let a desire for perfection be set against a desire to make progress. Because we're never going to get to the point where we have no basis risk. I mean, there needs to be an acknowledgement that any kind of insurance contract, even if I had health insurance, I would not then take up trapeze walking. So I don't eliminate risk by insuring myself, but it is true that the current status quo, if you parse the evidence base, if you speak to ministers, this reliance on ex post funding is extraordinarily damaging. It undermines incentives to do things that could save lives. And we saw this, I mean, with Ebola, this is front of mind for many of us. We have, I think, an estimated 11,000 to 12,000 deaths, an estimated $2 to $3 billion in aggregate costs and the economic hit. Ebola also broke out in Uganda, I think in 2000, and the number of deaths was on the order of 400. So much, much fewer. It was contained in a single country, and the economic hit was nowhere near as bad, and that's because they were prepared. They had incentives in Uganda politically to invest in resilience and monitoring, and they acted quickly. So we can see that there's a huge payoff to doing it well. The current system doesn't create those incentives. Insurance can help to do so. And just one final point is that I also don't think anyone is saying, Stefan and Daniel certainly in their book, and Lena has made this abundantly clear, no one is saying we'll insure things and then wholesale defund the humanitarian system. It's as we were saying in the green room before we came on, it has to be a two-handed offer. For those of us at the World Humanitarian Summit, we know that there are shortfalls, and we know that people are doing incredibly difficult, incredibly important work. This is part of helping them to do it better with more liquidity and more flexibility than the current system currently allows.
Okay, so Theo, just before we go to questions from the audience, just on the technical point of designing these disaster insurance contracts, how do they get over the kind of couple of problems that spring to mind, like when they pay out? How do you know exactly when they pay out? What are the kind of measures that trigger the payout? And how do they get over the problem that some developing countries have of creditworthiness barring them from access to capital markets?
I mean, I'm happy to say it, but I think Stefan and Daniel also have many excellent points to make on this. Basically, unlike many sort of traditional insurance contracts, if you and I think about insuring ourselves against things happening to our cars or things happening to our health, we have this innovation in insurance markets called parametric insurance. Parameter is a fancy word for variable, and this means that we can contract things on purely geophysical data. The wind speed is sufficiently fast for this to be called a cyclone, and so the insurance will pay out. The earthquake in Vanuatu, where I used to live, is sufficiently violent for it to be called a severe earthquake, and the insurance payout can come on time and as it's expected. And what this does is kind of disintermediate a lot of the things you're talking about, the reliability of the counterparty, the country. It makes it a contract based on something that everyone can observe transparently and cheaply, and that means that for many of these disasters, we can insure them in a way that maybe a couple of decades ago or 30 years ago wasn't really on the map in the same way. This is much more feasible. African risk capacity, the Caribbean pool, the existing sovereign risk pools have already started to do this, where we have parametric contracts that pay out based on observed geophysical data. I think, and I suspect our working group will nudge us towards thinking that those contracts should be much more available, that market should be much, much deeper.
Right, let's get some questions from the audience. What I'll do, we have a couple of microphones going around. If you have a question and I call on you, we'll get you a microphone. Please say your name, your affiliation, and then I'm going to encourage you to keep statements short and move straight to questions. So let's start with this gentleman here in the blue and the lady in front also in the blue to begin with. I'll take a couple of questions.
Sure. Thank you. Brad Kading with the Association of Bermuda Insurers and Reinsurers. So could you speak to the Insurance Development Forum, which is obviously a partnership with the World Bank, the UN, and the insurance companies, which is perhaps a way to actualize some of the research that you've all described. Do you have some optimism about that project, and could you speak a little bit about it?
Okay, and then...
Thanks. Diana Olbaum, I'm an independent consultant. I was hoping you could speak to the problem of corruption. And one of the issues with insurance, I mean, the good part is that it's presumably going to pay cash to the government, which could be a problem if there aren't enough controls over to ensure that it doesn't kind of disappear afterwards. So it's one thing when you talk about cash payments to individuals as a form of resilience and recovery, but I think there are different kind of concerns when it's a cash payment to a government.
Any more questions for the moment? Actually, there's three of you. Let me get these answers to these two, then I'll pick up these three questions next round. So Brad's question was about this World Bank project. I think, Daniel, do you know, you want to take this on?
Yeah, I'm happy to talk about the IDF if that's, yeah.
Go ahead.
Yeah, I mean, what we argue in the book is that to develop solutions that make sense and are going to really hold, you need a bunch of different people in the room. You need your scientists who are going to tell you what you can plan for, so you don't just plan for Ebola in West Africa and earthquakes in Nepal. You plan for what might happen next year in the future. You need your financial experts who can think about innovative ways of actually financing this sort of stuff. You need your public officials who are able to sort of try to put together a package which really looks at how can you design something where people are going to be protected and assets are going to be protected in advance rather than protected after the fact. And then finally, you need your frontline implementers who are doing fantastic work, but think how much better they can do if they don't have to fundraise during every disaster. So they can really think about what would the plan be, what would actually be done. And the IDF brings together these different groups and really is about trying to think about best practice in this area and what can be done better. So in terms of whether I'm optimistic, yes, I'm very optimistic.
So can I talk on the corruption point?
Sure.
No, that's we want to be clear. So you know, again, what we're not just talking about is simply having a trigger so that a lot of money comes into a country. Okay, so actually we go at pains to try to actually say, well, you want to make sure that there is a clear something, a plan, a system that is being financed. Okay, and so it's maybe what I thought also Daniel could have mentioned. So sometimes some of the worries, the early worries we have with things like ARC, is that actually it's one thing to get a trigger from a risk pool somewhere in Africa that actually then brings money to the Ministry of Finance, but then God knows what will happen to it. Okay? So the key thing here is to actually say, well, what we need to invest in is to actually have a system, basic principles of how we actually will bring this out. So let me give you an example. A country that so let's say occasionally comes in the news for corruption, Kenya. There we have a program called the Hunger Safety Net Program, which is, I think, World Bank and DFID is involved in it, and others as well, which is the following. It's all the time, it's a basic cash transfer program for a particular group of people. But it's designed in such a way that if a big drought happens, it can expand in terms of beneficiaries in a very clear, well-defined way, and it actually get more people that will be covered. So both the size of the transfers and in different ways it can expand. So it's set up in a way that during a drought, it can absorb more resources. So you have a system in place for distribution, and it actually is insured by policy with the ARC. And if we reinsured it essentially, if I may put it like this. Well, no, it was then also reinsured for the basis risk by DFID and other agencies in case ARC wouldn't pay out, but it looked like we're doing. So if the insurance policy failed. So this year, for example, it got triggered. ARC didn't quite pay out, but it's okay. So we had part of the humanitarian system, in this case, a number of donors that said, no, we commit then to actually give the money in it. Now, I would say that there's actually less of a risk of corruption because it's very clear beforehand what the system is going to be. That's what we actually financing. We work with government, but it's all very clear and transparent. And we've invested beforehand in setting up the transparent system of the disbursement. I would put it is much better than exposed descending onto Nepal or in a drought-prone area, whether we are with NGOs or whatever and parallel systems, and then thinking we can do this better without actually getting into the traps of corruption. So I would say actually the current system, but we'll never know, of course, because there's no proper data, there's no proper monitoring, there's no proper evaluation, because we don't have the data systems to properly evaluate humanitarian responses. But it's now far more risk because it's all exposed in a hurry, quickly done, and we need to get partners that actually do it on the ground, rather than actually say do it beforehand with a clear plan, with a clear decision-making, and with clear financing on standby to arrange it. So I would say far fewer problems with this system than you would have with actually the current system. But I can't prove it because we have no data on the system.
Did that pay out through the Ministry of Finance?
Sorry?
Did that pay out through the Ministry of Finance, the Kenyan example, or did it pay out through a World Bank mechanism that was already in place?
Look, this would have been, no, I just actually asked Daniel, how would it exactly the payout have happened?
So the payouts were made by Equity Bank, which used a principal bank agent model. People were pre-registered with bank cards, so it went to the individuals. In terms of how exactly the money flowed, I'm not entirely sure. Yeah, this is HSMP in Kenya.
So there will have been mediation from the Ministry of Finance, but it would have been very clear where the money had to, very clear ways of following the money, and actually were pretty transparent actually in the way it's set up.
Lena, do you want to take on that corruption question as well?
No, although I'd love to just tag on to Kenya, because I think Kenya is a really good example of what we were talking about earlier about these kind of layers of risk. So HSNP, the Humanitarian Safety Net Program, is set in place by the Kenyan government, supported by a number of donors, to support. These are the beneficiaries are kind of destitute people, right? I mean, they're very poor pastoralists in a very resilient deficit area, the northern Kenya, ASALs, the arid lands. What I think is interesting is that you get a government like Kenya, and they're starting to put in place, they've got HSNP, they're starting to put in place insurance program to catch the people that are just above HSNP kind of beneficiary level, right? So the idea is, in the case of a drought, to have those people not fall into destitution by protecting their assets, right? And then they're also, I think they buy into ARC as well, the Kenyan government does, in order to, say, rebuild in the do different kinds of, I think it supports things like the scaling up of HSNP, as you said.
Right, yeah.
So here's this example of a government using these various instruments that to cover different parts of their contingent liability.
No, and it just, I get quite excited about it because
Yeah,
it is
me
a
too.
very nice, almost textbook example how you could think about it. Because, this is a development instrument, a social protection scheme, a permanent cash transfer scheme that can actually be scaled up in a humanitarian situation.
Yeah.
So you bridge these gaps here. You get the incentives aligned because it's extremely clear beforehand who owns the risk and who's actually protected. There's a clarity there. This is a little bit what insurance can do, even if it's not, the people themselves don't think necessarily that I've got the insurance, but it's an insurance-like arrangement. It's like a contractual arrangement. There is almost like a social contract here that I know that I'm part of the system, and that when something bad happens, rather than the system collapsing as it often would do, actually it will work better. It is designed to actually be flexible in that way. So you get that social contractual arrangement is built in. So something from a development intervention that can actually be adapted to a proper humanitarian intervention. And then in the layering sense, where not so poor people, they can actually buy into these insurance policies that are getting the livestock insurance policies. So and so in the sense that we always say, it's really important knowing what risk, who owns what risk. That actually these not so poor farmers, they know that they won't be getting the charity from the government when the drought hits, that they actually are said, no, you are wealthy enough, you'll need to do the insurance. But we'll help you getting it, and it becomes part of the system, and we'll make sure that the system doesn't collapse during this kind of emergency, as it often does. It's actually the institutions are set up early on, and it creates a clarity.
Okay, panel, I know we have at least 4 questions left in the room. We have 15 minutes left. I'd like to get through them. So let me get those other questions. I know, gentlemen over here, sitting all on your own. I don't know why.
Hi, Joe Lightman from the World Bank's Global Facility for Disaster Reduction and Recovery. Lena made a very good point in the beginning that insurance is not the silver bullet, and I think that came out in the discussion. It's really a proxy for a way of thinking about risk. Exactly. Understanding risk, identifying people and assets at risk, and then being financially prepared to respond. I guess I'd make 3 points for maybe discussion or for reaction when we look at this evolution of thinking. The first would be that the focus on financial instruments and response to disasters and being prepared is very important, but at the same time, we don't want to lose an emphasis on reducing risk. And clearly, insurance creates the incentives to do that, but we need to go beyond that, and we need investments that reduce risk. Having said that, the second point is that disasters are still going to happen. And we need to be financially prepared, but we need to go beyond that as well. And there's preparedness in terms of institutional arrangements for responding to disasters, policies that need to be in place, and management instruments that allow countries to respond more quickly to recover. The best example I can think of recently is Nepal, where we lost 6 months of response to the recovery, to the disaster, to the earthquake, because the government didn't have the institutions in place. And when they did get them in place, there was political change that actually delayed things further. So institutional preparedness is also, I think, part of the equation. The third point is that risk is dynamic. And I think there's been a tendency to be very actuarial in the past with risk, and we need to be more probabilistic. And there are just 2 forces that are pushing us in that direction. The first is climate change, and the second is urbanization. So we've got these 2 forces that are changing the profile of risk as we move forward, and I think we have to be sensitive to them. Thank you.
Thanks, sir. There's quite a lot there, so why don't I get some responses to that before we move ahead. Theo.
Thanks. I have one minor disagreement. I think you're completely right on this insurance and incentives point. And there's one thing that we should probably be frank about, which is that my favorite thing at the moment, which is parametric insurance, has this very special quality, which is that it pays out based on hazard. And hazard is exogenous by design. Wind speed is not something that the insurer or the insured can affect. And so even as we think about parametric insurance contracts, we do need to do exactly as he's saying, which is think hard about what other investments we need to create incentives to make. For example, we will help with your premiums if you switch to greater distribution of drought-resistant crops. And that's something you can contract on alongside a parametric insurance contract. But unlike other kinds of insurance that are perhaps more familiar, like car insurance where I get lower premium for driving more safely, parametric insurance doesn't on its own in market prices create those incentives. So we need to think hard about how to do that. And that's a sort of exciting, interesting, and timely challenge. I agree that disasters will still happen. And I think that a lot of what we are talking about will create rheostats, trim tabs rather than on-off switches. One of the reasons purportedly that the WHO waited so long to declare Ebola an emergency is that they didn't want to switch the emergency switch on. One thing that we can do, and we have this kind of insurance thinking, these productive safety net programs, is that we cannot say it's either all hell breaking loose or nothing, but perhaps something in between, which matches reality much more closely. And finally, on this actuarial and probabilistic point, I think compared to Daniel, who's extraordinarily brainy and is an actuary, I'm a neophyte in this area. But I do think that the sort of catastrophists who we speak to in the context of our working group talk a lot about how these risks are being actuarially priced in to these models. So the models we're building do reflect changes in the world. For example, the threat of more violent storms due to climate change. So there's probably, I would say, from an external perspective, a slight more blending of those two worldviews than perhaps your perspective is, but I'd love to hear more. And I think Daniel, as ever, will make us smarter by telling us the real answer.
Well, no, I just want to clarify for everybody here and obviously online that obviously the definition of actuarial is like something really sensible. It's like, so actuaries, the qualifications, it's all about how to manage contingent liabilities, right? So maybe 100 years ago, how people used to run life insurance companies was a little bit different to now. So I think in terms of moving from actuarial to something sensible, I would say, moving from something not very sensible towards actuarial. So if I may, sorry, I say that as a fellow of the Institute of Actuaries. But on the broader point, yeah, obviously. So in terms of how do you make a society resilient against disasters, it's really important to get the risk reduction right. It's really important to get the planning right. The financial planning is only one part of it. And sorry, we talked a little bit too much about Mexico, but Mexico again. So last year the largest tropical cyclone ever in sort of the region, and almost no casualties. This wasn't because of the financial system, but it was because government made a commitment that it was going to be resilient against disasters. And one of the things it got really serious about is putting the disaster risk on the government balance sheet. But being very clear, what are we going to do and what are we not going to do? Setting aside the financial planning, setting aside the financial resources to sort of back up that commitment. And the big investments in risk reduction, the big investment in preparedness, they're all funded. They're built on this fundamental principle that the system is going to be funded in advance, and the system is going to be worked, and the system is going to be seen to be worked. So I think this, chicken and egg, which comes first, risk reduction or clarifying, who's going to do what and how you're going to do it, and putting the money on the table up front and committing the money up front. I'm slightly on the side of, I think, this sort of discussion about clarifying what you're going to do and how you're going to pay for it can be politically a little bit easier than firstly start talking about risk reduction in some cases, and can support these sort of discussions about risk reduction as well when you get the money on the balance sheet. But I mean, in terms of there are lots of big numbers about risk reduction can be a really good investment. But the question is, how do you unlock that given the political constraints during investments in risk reduction? I would say this: putting contingent liabilities on balance sheets, clarifying what you're going to do, proper financial planning can be a good way to start.
I just want to add something here, and it's not trying to get disagreement. Actually, I do agree with your points, but it's actually this kind of conceptual thing that we often get when in organizations like ours we talk about, say, disasters and the humanitarian type of relief. So the alternative to humanitarian exposed responses is basically, let's invest in resilience. We have to be very clear and careful what we actually mean by this at times. So it's definitely the case that by bringing out the risk more carefully and bringing and identifying the risk and the costs of risks, that if you were to handle it well, that you kind of start getting at least some kind of sense, wow, if only I could avoid this risk, it would be good. So then, and risk reduction is very important. So, but there is going to be that world in between that you allude to, you know, not least with climate change, extreme events getting more frequent. Stuff will happen. You know, we should not go towards these developing countries and saying, oh, instead of this humanitarian thing, we are going to invest in resilience now, our money, and then you'll never have a problem with drought in Ethiopia again or a flood in Orissa. Actually, no, these things will keep on happening. And so there is this thing in between that very little is actually invested in. It's actually the actual preparedness planning there in between that is actually to be clear. I don't want to overstate it, and we need to do a lot of risk reduction, but let's make sure we do it. If we context saying climate change finance, virtually no money is being used to actually prepare for the responses to extreme events. All the language is about, let's actually invest in the mitigation. And let's build in the sustainable infrastructure and so on. No, look, these roads will still get flooded. There will still be stuff that will be happening. How are you actually then going to respond and actually spend a little bit more of the money, say in the climate change finance space, to actually get proper preparedness there, that actually we also can respond and save life and reconstruct infrastructure that will continue to be destroyed. Because if we're going to build it for zero risk, we're not going to be able to afford it, and it's a bad idea anyway.
Okay, let's pick up one or two more of those questions. Gentleman at the front, and then lady there. That'll probably be it.
Thank you, Joe Kraus with the One Campaign. If I could raise, maybe this is an unfair question, but focusing on a very challenging environment. So take countries in the Sahel, for instance, Chad, Central African Republic, Mali, countries where governance is a real challenge, security is a real challenge. How do you get buy-in from a government that has very weak capacity and maybe not the strongest political will to provide for its people? Who's then helping fund the insurance? And then how do you ensure that it doesn't actually create a disincentive for a government that doesn't perhaps have the capacity or the will to provide for its people to just choose to invest in this insurance mechanism and then not provide or not work to increase or strengthen the systems or health or education, et cetera?
Okay, let me just pick up with that second question, actually.
Sorry.
Is this working? Oh, yeah. Okay.
Yeah.
This is actually a follow-up question on the first question the gentleman asked.
Just tell us your name and where you're from.
Oh, yes. Demal Allison with Amnesty International. So my question is, you talked about how the more affluent can buy into the insurance while the government supports the people who can't afford to. So in countries where disaster happens, often enough for it to be a pattern, but not enough for it to be always on people's mind for them to buy the insurance. That middle section that can afford to buy but chooses not to, what happens to them in that situation when disaster strikes?
Right. So allow me to speak to the point on more complex things. I want to first, your very last part of that point, governments may, by doing this, then they may not be focusing on other things. Look, we have something that is in literature well documented. Charity has it. Is that basically, and what I referred to earlier, this kind of sense that someone will come to the rescue for the extreme things I don't have to bother with. In that context, I'm not sure whether these countries have then better incentives when the system is all about exposed disaster responses, whether they have better incentives to invest in their own health and education systems and so on. I don't think you want to kind of saying, suddenly by getting them being better prepared for disasters, they won't be doing it. It's suddenly worse incentives than we seem to be observing already in some of these countries. Let's put it simply, the political will and the ability and the sense and the incentives for countries in some of these very fragile circumstances to do things, I don't think they will be undermined by this. But having said this, I'm not, again, this is also why I want to keep on making distinction. I'm not going to start selling insurance. You said, you're going to buy insurance. I'm not selling insurance to anyone. But I want countries to try to actually start with getting a good sense of what are the risks are facing. And maybe we'll need to help them working through some of these things. I mean, Daniel has been working in the World Bank in the facility that actually helps countries to think through this risk. I think it's a sensible thing to go to Sahelian countries, even with difficult governance structures and difficult and poor capacities to implement, to actually get them to think very carefully what are the risks we are facing, and actually how will we respond in certain contingencies. Okay? And then let's actually then think very carefully, what are the most appropriate instruments to do it? I doubt it's going to be in line with some of the earlier comments. I doubt it's going to be simply telling, and now you're all sorted, Ministry of Finance, just buy an insurance policy and then everything will be fine. No, clearly not. Let's make sure we have the systems in place and think very carefully through, if in Chad something happens, how are we going to reach the people? Is it going to be through government systems, or are we going to encourage beforehand governments to agree that this will be a shared responsibility with other organizations if this happens? How will we run the financing? Let's think very carefully about it. So this is not about simply saying, this is from now on simply saying, oh, well, we now write a check to the Ministry of Finance and then we'll get on with it. No, it's absolutely not. It's actually beforehand thinking through these contingencies. I think that's better than the situation now, where we know these are challenging circumstances and where we're not engaging in that dialogue with these countries. And then something happens, and then we all get in there and say, oh, it's a disaster, and everybody comes in, and then we'll get dozens of organizations speaking all kinds of different languages, French and others, coming in, not working together, and then actually creating probably more chaos on the ground than actually the process we're describing. So the challenge, I would put it back, is what is the counterfactual here? And starting the process to actually doing things beforehand and thinking carefully about how we will do it, how we will respond, and how we will set up financing for it to make the glue that these systems can actually work. I'm pretty sure we'll do better than the current situation where exposed we scramble for resources and we'll scramble for systems on the ground to actually deliver it in the end.
Well, Lena, can you take on that question?
I just wanted to follow up on that. And even if the system that gets put in place does not rely on a government that, say, where there's a failure of governance. Yeah?
Yeah.
So, right, and this kind of goes back to your question on corruption, right? That it's, you're not saying by planning ahead and having the finance lined up that it assumes that everything goes through an existing government. And in many cases, there's a failure of governance that you wouldn't want to work through.
But it is an important thing. When you read any evaluation, you can almost write a template for an evaluation for an emergency response. And it will always say, we didn't manage to find ways of integrating the government system with the parallel system. We didn't find ways of coordinating and so on. Actually, what we want to do is incentivizing this process, that you do beforehand at least think, how will I respond in Chad? And actually agree with all the different donors, speaking French and not French, how we actually will be responding, and actually have that conversation beforehand, also with some of the more different NGOs. On the ground, and some of you will know it, on the ground, it's quite a mess during this kind of crisis. Why don't we talk beforehand and start planning ahead beforehand?
Goodness me, that's radical thought. Daniel and Theo, just a very brief answer to that last point. Is there a kind of a potential loophole, I think the lady was describing, in countries where disasters don't happen so often that they're not always on the radar? There's a middle section of the population who are well off enough that they could afford to buy insurance but don't. Is there a kind of loophole there? What happens to them?
So prioritization is really difficult. When a disaster strikes, it's really difficult to prioritize, who to help and how and where. Prioritizing and making decisions beforehand is just as difficult, in fact even more difficult, because you've got to think about lots of different potential disasters. So one really interesting program is in Turkey. There's a Turkish earthquake insurance program which has been running for about 10 years, which is really incredible in terms of the way they've sort of tried to get homeowners to buy insurance against their homes. And still, after all this time, only about 20% of homeowners actually have insurance, the other 80% don't. So obviously this isn't full protection, but it's an enormous amount better than it was before the program started. And I think from the World Bank's perspective, we are, when we talk to governments and development partners about this, it really is a question of thinking through, who do you want to protect? What really is the priority? What are you going to protect them against? And who's going to pay? And one of the things that has already been talked about already is this idea of designing social protection systems that can flex in times of disaster, getting the systems, the transparent systems in place, getting the targeting in place, so that you can start to try to capture some of these people who, we know that a lot of people who are vulnerable, if offered insurance, even if it's subsidized, they're just not going to buy. So you have to be realistic about what insurance can do and what it can't do. But how can you fill those gaps, and who's going to pay for filling those gaps? So it's always going to be difficult, but it's not just a case of retailing, insurance products to individuals. There are other ways that you can think about protecting people, businesses, and government balance sheet as well. How to thought through together.
Wait a second, Stefan. Let me just. We have run out of time. Let me just get one answer from Theo.
I want everyone to ask Stefan to buy insurance from him after this. His perspective on this is not entirely clear. Just to sum up, this has been a lot of fun to hear, and I know Stefan has some final comments. But just to add to what Daniel says, it's true. I suspect there will be a missing middle. There is a risk of a missing middle, and beware of anyone who says that they have a 100% solution, that they have all the silver bullets, because I don't think, even in the context of this working group, will come up with a way to make this, to catalyze this in a way that covers all the risks all the time for everybody. But one thing that we should also think about is that proper disaster response, dealing with these hazards, investing in preparedness, is like the ultimate public good, right? It benefits everybody to some degree. And I'm always struck by the example of Haiti, which has slipped way below the fold of our newspapers, where in 6 billion of post-disaster aid, according to calculations by my colleague Dr. Vij Ramachandran at CGD, out of 6 billion of post-disaster assistance, 1% has gone through the government system. That's deleting the public capacity to cope and the public ability to deliver services. And that's a huge difference compared to what we're seeing with pools like ARC, with Pakrafi in the Pacific, with the Caribbean pool. And so while it is true, we may be leaving some people a little bit farther behind, we should also think that by making sovereign insurance real, scalable, practical, a rheostat rather than a binary on-off switch, we're also providing a public good that benefits everyone much, much more than I think the current system does.
Well, I just wanted to add actually this very important point is that, in the current system, you often are in a situation that people think they will be supported, but there is no clarity. You remember, you mentioned earlier what happened in the UK. This was actually good public policy to announce to people, look, you will not be covered. Your insurance company will not pay you out, and the government will not necessarily come and save you if you do these kind of actions. This is what I would say towards these middle groups. It's far more important to actually then bring it out and actually make sure you communicate as a government. These are the risks that you own yourself. You have to think about it, and these are the risks we own. Then this kind of ambiguous situation that we get usually, even in rich countries during disasters, that everybody thinks they have the right to the support. And then actually, as a result, they haven't invested either in the risk reduction, they haven't done the right actions, nor will they then actually, and then they leave frustrated afterwards because they think, this is really what the government should be doing. It would be a sense of good public policy to create this clarity. And that's, again, when we're saying planning ahead will make a difference, is that actually you will communicate with your population. These are the farmers that will be covered. These are the people that will not be covered, and actually create something. Yes, there will be issues there, and there will be issues there, but it's far better than the ambiguity where we live in, where we don't bring out the risks and we don't communicate to people who owns the risk, what is protected, and what we're doing, and what we're doing during disasters. And that's, I think, a key point of this thinking. That's why we need to bring this out much more explicit.
Absolutely.
Okay, panel, we have run out of time. Ladies and gentlemen, thank you very much for joining us. If you want to go over what we've talked about, the live stream will be archived on our website, cgdev.org. You can find blogs written by Theo about this as well, including one about this event soon. Just going to strong arm into doing that. Panel, thank you very much. And ladies and gentlemen, please give them a round of applause. Thank you.